Hey everyone, Happy New Year. This is the first edition of That's Our Two Satoshis Live of the new year. I am Jeff Dorman, Chief Investment Officer at Arca, joined today by Head of Research, Katie Talati. How are you, Katie?
I'm good. Thanks, Jeff.
Okay, Katie has her own show every week as
Yeah.
well, but joining ours today, so it's a nice crossover for the new year here. You can promote all of your tweets in your own show at the end here. Before we get started, though, as always, let me go find the disclaimer here. Uh, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. All right, Katie. Every year, we always do a 2023 predictions piece. We've actually had some pretty, we've done pretty well, over the 5 years we've been writing about the digital assets markets. Last year did not do so well. Missed the mark on pretty much everything in terms of our themes, or maybe not missed the mark, maybe just early. But we are back again for this year. Certainly coming off of a pretty bad year in the digital assets market. I don't think anybody really fared too well last year. But we got some big things that we're expecting for this year, some of which, maybe 3 to 5 years in the making, others that are more directly attributed to some of the carnage that happened in 2022. But why don't we dive right in? As always, people, you can look at our blog on ar.ca/blog. We write in written form. We always, every week on Monday, release something about the markets. Or you can just follow along here. So the first one, and Katie, I don't know if I wrote these. Some of these obviously you contributed to. Some of them you didn't. I don't know if you agree with all of them. But my first prediction, and we have 5 of them here, is that the digital asset market will continue to decouple from traditional markets. And I'll give you my rationale really quickly. Then I'd be curious to hear your thoughts. So my rationale is that, first of all, basically digital assets decoupled most of last year anyway, right? It was only the first half of the year where digital assets were really following the macro picture with rising rates and the Fed and everything that's happening to the equity and debt markets. But really, post Luna, most of the performance in digital assets was specific to the Luna UST crash, the FTX debacle, as well as on the upside, the Ethereum merge, and really had very little to do with what was ultimately happening with inflation and rates. But more importantly, I actually think while digital assets decoupled to the downside last year, I actually think there's a good case to be made that they'll decouple to the upside this year. And the rationale for that is that when you get into a recession, whether we have a soft landing or not, I think we're heading into at least slower growth. When you get into those environments, that's when you generally have defaults in corporate fixed income. It's when you generally have depressed multiples in the equity market because cash flows are going down, especially as interest rates are going up. Obviously, anybody who's done just traditional DCF modeling or any sort of traditional financial modeling, the asset value of both debt and equity securities will go down when cash flows go down and demand for their services go down. But the interesting thing with digital assets is that because these are hybrid instruments, and when I say digital assets, I'm not talking about Bitcoin. I'm talking about Web3 and DeFi and everything else, layer ones. Because these are hybrid instruments and derive some of their value from revenues and fees, but also derive some of their value just from the optionality of future services and rewards and essentially loyalty programs, that they'll do much better in a recession. And for example, the Luna blockchain, right? The Luna blockchain, for all intents and purposes, filed for bankruptcy in the sense that it blew up. But the Luna token still has $1 billion market cap, and that's because blocks are still being produced. The blockchain itself is still functioning. There is some sort of optionality with regard to what the new Luna might look like, in 5, 10, or 20 years. And because these protocols can't go bankrupt, because they can't get primed in a restructuring where the equity goes to zero, you could actually make an argument that tokens are actually safer than equity. And you're seeing that now with the FTX equity at zero, BlockFi equity at zero, Silvergate potentially heading towards a restructuring, obviously Celsius, Voyager, you name it. For all the people who said, oh, I'd rather just invest in the equity to get exposure to blockchain because it's safer, we're actually finding out that equity might not be safer because there's a real mechanism for it to go to zero, whereas these tokens never really go to zero because of that optionality. So that's my first prediction, that we will decouple mostly to the upside in 2023. What do you think?
I think there's a potential for that to happen. I do think, though, on the other hand, we're heading into a macro environment that crypto hasn't performed in before. And we don't really know what's going to happen in a recession. I do, though, understand what you're saying about kind of like the split between like loyalty tokens that maybe have like other value besides just like things like the cash flows, repayment of debt. But right now, that's only a slice of the digital asset market. It is the growing slice. Like if you look at, kind of, and we'll talk about this later, like the corporations that are getting in, a lot of them are looking at using digital assets from that customer brand loyalty angle. But I think it's going to be really hard for everything in the asset class to perform well. So maybe that's just like one segment that will perform well in a deteriorating macro environment.
Okay. Well, keep your eye on the tokens that do have some of their value driven from community and loyalty and rewards more so than just financial value and revenues, because I think those will be the ones that outperform this year. All right. Well, you already teed off number two. So prediction number two was that most of the growth of digital assets this year will come from partnerships and other corporations and not necessarily organic growth. And what I mean by that is, and I think anybody who listens to this every week probably has heard me say this before, but I like to draw an analogy to the .coms back 20 years ago, right? The early .coms were businesses and companies that would not have existed if not for the internet. And it was 5, 10 years later where traditional companies started using the internet, right? So the early big internet companies were pets.com, priceline.com, ebay.com, right? These are the companies that wouldn't have existed if not for the internet. But today's biggest users of the internet are companies like Walmart and Disney and JP Morgan and Domino's Pizza, right? Companies that already existed and found a way to use the internet. I think we're in that shift right now where the early, quote unquote cryptos were these infrastructure plays, right? Your layer one protocols, your, things like, Chainlink and DeFi applications. But ultimately for these to really grow, you are not going to just grow organically from new users who find these protocols. You're likely going to onboard existing user bases from your Disneys and your Starbucks and your Reddits and your KKRs and your Apollos and all these companies that have already gotten involved in some way, shape, or form with Web3 or NFTs are going to continue to kind of come over to this world and bring their users and their customers with them. So I think that's where I'm looking for growth. So I'm looking for companies like Chili's and Polygon, protocols like Polygon that already have big presences with corporations. You can say the same thing about Providence and Mike Cagney's company, but you name it. Anybody who has real ties into corporate America and corporate finance are likely to grow the fastest in 2023. What says you?
Yeah, totally agree with that. I would also mention Flow Blockchain and Dapper Labs, since they've been doing a ton with like Live Nation and the NBA and the NFL. I think that, overall, the way I explain it to people is that what we have today and what I think the difference is between now and say 2018, when you had all these headlines of like enterprise adoption of blockchain, like JP Morgan is creating their own blockchain. That's not the adoption we want to see, right? That doesn't help the space grow necessarily. It's just saying they're taking the technology, making a private blockchain in-house and utilizing it. Now I think what's so interesting is we're actually seeing those corporations come in and say, hey, we want to build an ecosystem and we want to use the existing tools and infrastructure. So you see them partnering with Flow Blockchain, with Polygon, with Ethereum. And that is so much more powerful because that really does show that like over the longer term, we can bring in users from this, from these traditional companies, and they're going to use what already exists in here today instead of trying to build out some like siloed system that only serves their purpose.
Yeah, 100%. And I think like nobody in the corporate world wants to be first, and nobody wants to be last. But we've now seen a couple of pioneers basically in every category, right? You've seen the pioneers in the financial space like KKR tokenizing a fund, and Apollo tokenizing securitizations, and even JP Morgan and BNP, do a DeFi transaction. You've seen it in the retail and consumer world from Starbucks and Nike getting involved in NFTs. You've seen it in the sports world with the NFL and NBA and NHL and English Premier League and others getting involved with fan tokens. So now that you've had precedent from a few larger companies, it's just a matter of time before everybody dips their toes and it gets in it. And I think the estimate is there's somewhere around 200 to 300 million people who have used blockchain technology in some way, shape, or form. that's smaller than like the customer bases of like, Visa and, iTunes and things like that, right? So you can just imagine how big of a jolt this industry gets when you start to port over some of those users. I think a good example was, for those who don't know, there's a token called Sweat. Sweat was an existing Web2 company that had 100 million users. They decided to build out a Web3 version and launched the Sweat coin. And I think 14 million of their 100 million users downloaded a wallet on the first day on the Near blockchain, and that was over 100x more users than Near had beforehand. So you can just as an idea of just how big and impactful this can be when these larger existing companies start to bring over their user bases. So look out for more of those. We're definitely investing in companies and projects that have strong Web2 and corporate partnerships. Okay, number 3. Because of the lack of faith in centralized institutions, specifically around FTX and Celsius and BlockFi and Voyager and all these different failed exchanges and lenders, that we're going to continue to see DeFi eat into this market share. And I think one of the charts I like to use, and in fact I put this chart in the blog itself, was looking at decentralized derivative decentralized exchange volumes relative to centralized exchange volumes. And if you go back to before DeFi was even really a word that anyone knew, back in 2019, early 2020, DeFi represented less than 1% of total volumes. And now over the last 2 years, it's averaged about 10 to 15% of total volumes. And I think you'll start to see the same thing happen with regard to lending activity, with regard to decentralized derivatives, and ultimately even some traditional finance companies, like we've just mentioned, JP Morgan and BNP, start to experiment with DeFi as well. So I think, ringing endorsement last year for DeFi, that every single company that went down had a perfect substitute in the DeFi world that performed great. So you look at FTX went down, well, DYDX and GMX did fine. BlockFi and Celsius went down, well, Aave and Compound and Maker did fine. And you go down the list, and all of these different DeFi to CeFi projects and companies all have the exact same customers, but the decentralized versions who adhere to code performed exactly as you'd expect because the code doesn't discriminate, whereas the centralized versions who had individuals making decisions and often bad decisions were the ones that failed. So I think right now we're thinking about 2022 as just a bad year all around. But I think over the next 3 to 5 years, that narrative probably changes to 2022 was just a ringing endorsement for decentralized applications. And I expect that market share to jump. So I know you agree with me in whole, but anything to add there, Katie, on specifically how you see that transition happen?
Well, it's interesting that you bring that up because I actually think it dovetails really nicely into some of the themes that we outlined in our 4th bullet, or in our 4th prediction. I think DeFi for sure has, the narrative is there for it to succeed following all of the implosions from last year. And I think, it just really starts to remind everybody in crypto, like why we, set out to create decentralized protocols and decentralized organizations. But I do think in order for DeFi to be ready for, more prime time, more users, more adoption, there's a few things in the way besides regulation, which we won't talk about, before we can get there. So
I agree. Why don't we just go? I think since we agree on that one, it's no fun to banter if we agree. But why don't we go right into number 4? So number 4, as always, in fact, I think this is our prediction every year, but we have different subcategories. But prediction number 4 is that thematic investing will matter. And actually, last year it didn't matter at all. In fact, the equity market had the greatest dispersion we've ever seen in terms of sector performance, with things like energy doing well and tech doing poorly. But in the digital asset world, it was the opposite, right? Pretty much everything was down 65 to 85%, no matter what you looked at, and there was no dispersion. But I think that was the anomaly. Every other year we've been doing this, we've seen really big thematic investment themes drive returns, and I think 2023 will be no different. So why don't I turn this one over to you? What are some of the themes that you and the research team have identified and really believe that whether it's 2023 or slightly beyond that, will be a focus for us as investors and for others to be looking at?
Sure. So, it's hard with some of these themes. I will preface by saying some of them I'm not sure will play out in this next year, but may take a few years just because some of it is like very, very new. The first one is decentralized identity, so or on-chain identity. This has already gotten a lot of mentions in the press, but so I wanted to just kind of explain at a high level why it's important. So the reason you want on-chain identity is two reasons. First of all, you help solve some of the KYC AML issues that actually prevent a lot of institutional investors from getting interested in the space, because they don't want to be potentially interacting with a bad actor and being found in violation of the Bank Secrecy Act. So on-chain identity in the form of, hey, we know who Jeff is, we have his KYC documentation, and we can keep that up to date via his wallet address. And he can then interact with all these DeFi protocols, and they can know he's a KYC'd individual, he's not a bad actor, he's not laundering money. The second piece to that is that once you have on-chain identity, you can start to tie other things to it, such as credit scores. Again, once we start to get into that territory, that's where you start to have the ability to have more capital efficiency. I think part of the problems of what we had last year was that their capital in the system is so inefficient, that what happens is that people are able to, lend and borrow in several different places, and there's no way to necessarily track it depending on who they're interacting with. There's a lot of money being kind of like rehypothecated, and you can't. And so I think like having this capital efficiency will help. And then currently, there's no real way to bridge real world assets on chain and say, hey, like I would like to take out the loan, but I don't have like the collaterals in my bank account. So you'd have to move that on chain. So the idea here is that eventually we should be able to bridge all those things and create better capital efficiency with something like on-chain identity. So that's a huge theme. And again, this dovetails into, this is what would help DeFi, is if we can, kind of solve for this.
Any tokens off the top of your head that fit that theme that are more
so there is like several tokens. There's several projects working on this problem right now. It's difficult to like name one that's like done it better than others. I think the best one that comes to mind off the top of my head is of like on-chain identity is Ethereum name service, or ENS. I'm sure you guys have seen everybody's like .eth name or wallet address. That, however, doesn't really, that kind of like scratches the surface of like what we want to do, or what we want to see. We want to see like all kinds of credentials and stuff tied to like somebody's wallet address and somebody's on-chain identity. This is basically buying like a short email address for your wallet.
Got it. Okay, so on-chain identity, decentralized identity, I think that's number one. Number two, I think we'll skip over because that's broad partnerships and adoption. We already mentioned that one.
Yeah, so we already talked about that. I think the third thing I have on there is scaling. So scaling, basically, I think that if anybody was looking at what, activity in 2021 and 2020, we basically maxed out all the capacity on all the blockchains that were available. And while scaling solutions were being worked on, I think it's now more important than ever that if we're going to start bringing in millions of users via partnerships with Starbucks and Live Nation and Instagram, like the blockchains we have today aren't technically not prime time ready to handle that inflow of users and activity. So scaling is going to become even more important. And not just in terms of handling the capacity and putting through transactions, it's like having lower fees. And when all that happens, you can actually have adoption at like a really big scale. And that, again, is kind of what we're going through for in terms of like how we want to see things grow. And this feeds into every part of the market, whether it's NFTs, it's, consumer brands, it's DeFi, it's, I'm trying to think of every other area, but you understand my point, is like, it really kind of touches every point of transacting on chain. So I think that's very important.
And something that, I think the market participants tend to be very recency bias, right? So maybe, in 2021 early 2022, when things were going bananas, everyone was focused on scaling. In the last 6 months, there's been a dearth of activity in blockchain. So all of a sudden scaling doesn't become part of the focus. But I think you're right. When you're seeing these big corporate partnerships and you're seeing these events that drive a lot of users all at once, if we don't solve scaling, you're never going to be able to grow. So I think it's a good thing. It's an area where you can probably invest maybe more cheaply today than you were able to in 2021 when it was top of mind for everybody. Okay, moving on to the next one, non-custodial wallets.
So basically the idea of, not your keys, not your keys, not your crypto. I mean, that was like the lesson from this last year, is that we have got to, people have to not trust intermediaries. It's interesting because I do think a lot of people got complacent. We trusted exchanges, custodians, banks, and these centralized lend borrow platforms, when in reality, we have no idea what they did with, assets when they were sent in there. It was kind of a black box. That's not the case when you transact on chain, when you keep custody of your own assets in your own wallet. And I think there's definitely a much bigger push now to go in the non-custodial direction, whether it's with storage or lending and borrowing, trading. I think people are much more attuned to the fact that they want to hang on to their money.
100%. Yeah, I think that's a pretty obvious takeaway from last year. It'll be interesting to see who steps up and really solves some of those problems going forward. Okay, next one: security and testing. Another one that's probably more of a derivative of what happened last year, right? Was we saw record DeFi hacks, record exploits. Those that are going to be able to help get in front of this and prevent, or at least warn of some of the risks should do pretty well. What exactly are you looking for with regard to that?
Yeah. So I mean, with this one specifically, it's the same idea as scaling, right? We can't have insecure blockchains, we can't have exploits or manipulation of certain markets if we expect that, the next couple million set of users are going to be coming into the space. And they're not going to be nearly as educated as we are on, approving transactions, understanding when something is spam or depositing money on a bridge, is that safe? So I think like the security and testing practices have to become much more rigorous. And it's everything from simulation testing to, actually testing, auditing code, and testing for kind of like loopholes. I think, in general, the space has a mindset of like test and prod, or, the idea of like, hey, we're just going to test in the real world environment instead of actually making sure things work before like deploying them. And so I think that that's going to become a bigger theme, is like people are realizing we can't just kind of throw caution to the wind anymore, especially when we're talking about, any DeFi protocol that has billions of dollars of TVL locked up in it. A lot of people asked me over the summer with the Ethereum merge happening, like, why is it taking so long? And like, what are they doing? And like, I was trying to explain to them, like, they're actually testing everything like top to bottom very rigorously to make sure that there aren't any issues. And that's kind of like, I think, the stuff that you want to see from any project. But I also think more and more, you're also seeing more solutions emerge to kind of assist those projects. Most of them are kind of like consulting type businesses right now, but I think it's going to become more of a focus in the next 12 to 24 months. And again, this is something that's going to help get things like DeFi ready for prime time.
100%. All right, last sub theme that we're looking at, or at least last sub theme that we talked about publicly, Web3 social movement, right? Obviously, ironic in the sense that we distribute this show on Twitter, but I think everybody has their Twitter pain points. What are you thinking with regard to decentralized social, or some competitors ultimately to the centralized social media platforms?
So I used to actually kind of scoff at this one and think, hey, this is not something that's going to happen for like 5-10 years. But I actually think with what went on with Twitter the last few months, I think it's becoming more of a front and center problem that people, have their eyes and ears on. I mean, at the end of the day, anybody who's like a creator, an influencer, working and using any type of social media, whether it's Twitter, Facebook, Instagram, uh, or Twitch as kind of like their main go-to platform, they know that they're at the mercy of those platforms. They can get, removed at any time. They, have limited ability to monetize their following. And a lot of them, most of the time they don't own their own data. So the switch to Web3 it's the same thing, or the same thing as switching Web3 socials, the same thing as switching to Web3. It's the idea of like taking ownership of your data again, having that, the idea of sovereignty or ownership. And it's the idea of being able to monetize your own channels. The fact that Twitter, is essentially getting free content from a lot of different people on, the platform, but those people can't get paid unless they get subscribers to their Substack or their YouTube channel. That's kind of difficult. So, we're really looking towards that as the future. And there's definitely some really interesting projects tackling that so far. We've got like Lens Protocol, which was actually built by Aave of all things, and another one called Farcaster. And they're fairly niche right now, I would say, compared to a Twitter. But I do see that those could have growing influence and growing attraction in the coming years if, these centralized social media outlets continue to have the same problems that they're having now.
Sure. Yeah. Well, look, I think there's a lot of big ideas out there. I think the one major takeaway is that every other media article is about the crypto being dead, and I think it's far from that. You can see from some of these projects and some of these individuals that are trying to build solutions here that we're far from done with regard to building out the digital asset space. Our final prediction, just blow through real quickly, is that distressed investing will become a really big part of investment returns for the next couple of years, really more than 3 to 5 years than 2023 alone. And I think distressed investing will be really interesting because there's not a lot of crossover. And what I mean by that is a lot of people in this space come from a technology background or come from a venture background and maybe aren't as familiar with the distress process. And then the traditional distressed investors really are too big for this space. Some of the how scattered these retail claims are at places like BlockFi and FTX and Celsius and Voyager makes it hard to accumulate a large position at one of these large distress shops. As a result, I think there's going to be a pretty big window of opportunity for those that actually do understand credit and distressed investing and have a longer term horizon. So I think those who are paying attention to the different bankruptcy processes and are on the dockets and looking at these, I think there'll be a fair amount of opportunity to invest in some of the trade claims, as well as some that haven't even happened yet, right? This is not the end. I'm sure there's going to be more restructurings and more bankruptcies coming in the next 6 months. I don't think it'll necessarily negatively affect asset prices, but certainly will affect those who own the equity and debt instruments of these companies. So I think distressed investing will be a big focus. My guess is that that actually leads to a lot more exodus from Wall Street into digital assets. There's a handful of experts out there right now who came from the distressed world that are already in this space full time. I think more and more will happen there. So I'd say keep your eye on distress, whether you're investing in claims or not. I think following these stories will certainly matter as it pertains to new fund flows into the space and new investment return perspectives. So with that in mind, I think we'll kill it there. We've been on here for half an hour, but I do think the big takeaway for me for 2023 is that while you might look at 4-year cycles in digital assets and look at the 2018 bear market and the 2022 bear market, I think there was one really big difference between the two that matters the most, which is when we came out of the 2018 bear market and headed towards a 3-year stretch of pretty outsized positive returns. That came at a time when blockchain really hadn't produced much product market fit. We still had just Bitcoin and a few layer ones that had potential, but really didn't have a lot of activity on them. And it was a lot of guesswork with regard to whether or not digital assets and blockchain specifically was going to find use. You go to this bear market of 2022. Well, now we have 4 legitimate use cases, right? Stable coins are real. DeFi is real. NFTs are real. And obviously Bitcoin still exists as well. So you already have 4 areas of really strong product market fit. And now we have to just expand upon that with companies and projects that go deeper into creating more value around those 4 basic themes. So I think it's a much easier investment opportunity in 2023 than it was in, say, 2019. And we'll see if, we'll check back at the end of the year and see if any of our predictions are correct or not. So in the meantime, as always, thank you guys for listening. You can check out our blog at ar.ca/blog to read the whole thing. And you can follow Katie Talati at Katie Talati on Twitter and also listen to her weekly show, What's Driving Crypto Prices. Is that the right title? I don't even know.
What's Driving Token Prices?
There you go. What's Driving Token Prices? But you can find her once a week there on Wednesdays. Thanks, everybody. Check out the blog, and we will see you again next week. Happy New Year.
Thanks for having me.